Back to the Denver Radio Real Estate Show. I'm Cheryl Garlock with Colorado Front Range Properties, and my very special guest is Chris Z. I've reverted back to that, Chris.
That works.
Okay, Homebridge Financial Services here. And we are talking about the 5 nasty surprises that can stop a home purchase cold. And Chris certainly has had his years of experience in this industry as well as I have, and found out that we get some unpleasant surprises now and then.
Yep, that is absolutely true.
Now, before I talk about this next one here, I did want to tell you guys that I went ahead and found an article from the Forbes magazine, and guess where Denver ranks on the list of best places to buy in housing.
The country. I'm going to guess we're up there pretty good.
We are number 4.
That's
I
awesome.
sort of cheated on that one. I sort of let that slip out there. But anyway, number four. Okay, so we are one of the most affordable places to be able to buy as far as a large metropolitan area, is concerned here. So let's talk a little bit about some of the things here that might stop a home purchase cold. And one of those things is the lender might demand home repairs. Now, how might this happen? Chris, you deal with this.
Yeah, and in our market today, one of the things that we have to do is the Division of Real Estate is encouraging the realtors to send us the inspection information. So that a lot of times will bring up questions as far as what needs to be fixed. But also when the appraiser goes out to the property, like on FHA, you have to have the 3 S's is what we always used to call them: safe, sanitary, and secure. And so if there's chipped paint, on an FHA because of the lead-based paint issues you might have, if there's broken windows, those sorts of things, roofing issues, that kind of stuff, the appraiser has to mention that as part of their normal standard practice. And so, that's going to come back with the appraisal, and then all of a sudden I become the bad guy and say, hey, we got to have some of this stuff fixed, or, we've got to deal with it in some fashion. And it's always in the consumer's best interest, but it's always, hard for folks to understand that when they're in the middle of that emotional process.
That's right. And I'm going to comment on that here because you did mention the inspection issues there. And there are usually about 3 parts to negotiations and on the basics, I might say, for a real estate transaction. First is going into it up front, what you're going to offer and how you're going to negotiate. But then you come to the inspection. That's usually when we do that.
Yeah.
And on the inspection part there, the buyer will come up with a list of different things typically that might need attention. It's better if you, the homeowner, have already addressed this and taken care of it. But let's say the typical thing is you don't know about it and you didn't know about it there. Resolve it on a friendly basis first before you have it documented into what's called the inspection resolution agreement. You don't want your lender asking for an inspection report or requiring one.
Yep.
So keep it clean and simple. And I do think that this means that sellers need to be paying attention more closely to what might come up on an inspection issue. And that means your realtor needs to help you identify that at the time you begin to list the property.
Yep, absolutely.
So, sometimes I'll recommend we do inspections ahead of time.
Yep,
so that we have something, we know what to deal with there, but that can definitely be an issue there. So it's important that be written correctly. Another thing that you have to watch out for that can stop a home cold purchase, and I did just have this recently happen here, unfortunately. I was representing the buyer here, but the home has baggage. You know what I mean by baggage there?
Tell us.
Okay, I'm going to tell you. It's kind of like these boyfriend-girlfriend relationships that have come and gone, so to speak.
Skeletons in the closet.
Yeah, that's exactly it. Well, guess what? Homes can have that too. So, for instance, you might have an owner that you can also have this happen with a buyer who they haven't done their homework either correctly. A bankruptcy on their record.
Yep.
In the case of the homeowner, that's going to tie up the property there. Also, you could have mechanics liens, or you could have a judgment on there, or you could have missing permits. All of these things need to be clean right before you go ahead and put that property up for sale. I did have the unfortunate experience here of having a property that I put under contract here. It was not my listing there because I would have done the title search on it a little bit better than what they did. But the truth of the matter is that they had a bankruptcy on there. They kind of forgot to tell their realtor.
Yeah.
And you couldn't get it out of bankruptcy court too easily.
Yeah, and I think the one thing too is the mechanics liens. I mean, as much damaging weather is what we've had over the last several years with hail and flooding, and I think it's critical, again, having a good realtor that's going to look at the title information and make sure that the guy that put the roof on a year ago got paid and was happy, and that's not hanging out there.
Now let's talk a little bit about some of the financial requirements here that the lender might have there, and that might mean about like how much money you make, how much you have in savings there, the stability factor.
The stability factor. Probably the best advice I give customers, one, I like to actually talk to customers a few months really before they're ready to buy a house, and there's a really big reason why. One, we can get them pre-qualified. That's a critical piece, especially here Denver's in the top 5, top 4.
Right.
The market's crazy, and we want to make sure the customers, as complete as possible, so they look as good in negotiation as possible. But the bigger thing is, especially with the generation of folks, the younger generation right now, is making sure the finances are tidy, if that makes sense. In our
Makes
era,
perfect sense to me because I'm in this business, so I get it.
And in our parents' days, they had one bank account, checking, savings, poof, that's it. A lot of the kids coming out of college, and such, they've got 20 bank accounts with $15 in each of them, and they move money around all the time. And that's okay, because that's how they do things, but it makes it a nightmare for us as we go through that process, because we've got to document where money's coming from and moving around, so that it, as part of all the various new rules we have.
And I think it's really important that everyone understands, and I don't think people always so understand. They just figure, hey, well, I'm paying the bank, okay, big deal. But you need to think about it this way. The bank usually has more risk into the property by far than you as the homeowner do. I mean, most people do not pay cash. It's great when we do, but by and large, it's not the best thing to do either, as I'm sure we'll address. But
yes.
Nevertheless, the banks really have more skin in the game, if you will.
Yep.
And so therefore they really do have to take a pretty active interest. That's why they ask for all the documentation, because they don't want the property that they're loaning you money on to become another statistic in the foreclosure arena.
Yep. Well, if you think about just the basics of buying a house, 95% of the people out there buy a house with a mortgage, and so even if you're putting down 5% or 10%, on a $300,000 house, that is a very small percentage. So the bank does have a big piece, a lot of risk in there, because for some reason you don't pay that mortgage back. They're the ones that have to deal with getting their cash back in the bank.
And I got to tell you the truth, it's not so easy that they just get the property back. I mean, you know how many properties they actually get back, and then there's a lot of junk they got to do to those properties.
Yep.
A lot of rehab, a lot of work to it. So we're talking lots and lots of money. So their risk level is really, really great. They just want to make that loan to somebody who absolutely will not go into default there. And it makes it even harder if you're self-employed too.
Yep. Absolutely.
We're going to talk more about that here, but I got to first to the Denver Radio Real Estate Show. I'm Cheryl Garlock with Colorado Front Range Properties, and my very special guest today is Chris Z from Homebridge Financial. I've had to truncate Chris's last name because it's not that difficult.
Chris Zadra.
Chris Zadra. What's wrong with me? I can't make a short name sound good. I don't know. But anyway, hey, we've been talking a little bit about, the unwanted surprises, you might say, that can happen during a real estate deal. And one element here I wanted to mention too is we as realtors always talk about getting pre-approved. And you do need to get pre-approved. And there is a difference between pre-qualification, which is always a starter point, but then there's a need to get pre-approved here. But once in a while, you can find out, one of those things that can cause a deal to go cold, okay, is that the lender changes their mind on the pre-approval.
Yep.
Why might that happen, Chris?
Well, first I want to kind of talk to you about there's really 3 different pieces to that whole process. The pre-qual is basically the 20 questions.
Yeah.
I have to believe what you tell me.
Yeah.
Most of us pull credit at that point, but some lenders don't. But credit obviously is a big piece of that. The initial pre-approval, which is how the market works today, is we get the information, so we get a pay stub and a bank statement, the appropriate things for that person, and we run it through an automated engine.
Right.
Fannie and Freddie have created, the conforming world has created basically automated engines that say yes, no, that kind of stuff. Basically, it's like your MLS, junk in, junk out.
Yeah.
If I say somebody has $50,000 and they really only have 10.
Yeah, well, that's a big difference.
Yeah, and they're pulling, maybe the ratios are tight, or they've got some questionable other things in there. You might go from an approval to a not approval. Mm-hmm. And then really the third part, which isn't practiced as much today, unfortunately, is the full pre-approval, which means I'm giving it to my underwriter. Unfortunately today, because there's fewer of us out there, there's
we don't have so much time.
There's so much time, and it's a lot harder to get it looked at. But for myself, if I have a customer that's kind of shaky, or I want to just really make sure, I'll get them through that process, and we can kind of do that.
Or if they have a rather unique situation.
Yep, absolutely.
But a good loan officer can really help you guide them really well through that whole pre-approval status, because you've done enough loans.
Yep. Well, and you asked a few minutes ago, why does the bank sometimes say yes and then say no? one is maybe somebody made a mistake. Obviously,
Mm-hmm.
that happens, and unfortunately, that causes some issues sometimes. But a lot of times, what will happen is, all of a sudden, we'll get the approval. We'll think everything's great. This is why I like to collect everything up front before you guys even hit the car. And now all of a sudden, I get a piece of paper that shows, the $3,000 that they had in the bank, they borrowed on a credit card that they didn't tell me about, or, there's stuff that people don't think about in their everyday lives that is not a big deal in their world, but is a major deal in our world. And so a lot of times that is one of the big things that causes those approvals to get a little sideways.
And I got to tell you, I do tell everybody, I said, the only thing that the lender really doesn't find out about, and this is why it's so important to start with the lender, and here, get a good realtor and a lender, and a good realtor is not going to show you before you get connected with a really good lender and get pre-approved.
Yep.
That's really what you want to do. And the reason that is that, because, now I just forgot what my reason was, is that,
Well, making sure that they have everything taken care of and making sure that they do truly have that pre-approval process, so that nobody's wasting their time. And it's a lot easier to tell somebody they may not qualify before they start looking at a house.
oh
If
yeah,
that happens.
don't want to get them excited.
Then after they've done the inspection and the appraisal, and they've already thought where they're going to put the couch and all that kind of stuff, and then it blows up, and then everybody's really upset.
Let's talk about now on the flip side here about buying a home. Should they be buying a home today, or should they rent? What do you think?
I get asked this question all the time. It's a terrible idea to rent in my mind. And what I always tell people is, let's say you pay $1,000 a month in rent, okay, and you're a 5-year person as far as renting.
Oh gosh, think about all that money.
$60,000 you just threw in the trash.
Uh-huh.
That's, literally flushing it. There's no benefit to you. If anything, it's more of a pain in the neck for you. It's a great time to buy a house. The prices are up a little bit in Denver market, which is unfortunate. But really, the biggest thing is rates. Good grief.
Well, it's just like those properties I was just showcasing here. The payments on those things are cheap. Those payments there, those houses that I was quoting, those payments on will rent for far more than what those payments will be.
And I get asked a lot of times too, should I pay cash? To me, paying cash, if you've got the cash and you're in that position, that's great. I personally think it's a very bad idea because most good financial planners can get you a rate of return that's better than what you're paying right now on a mortgage. If rates are at 8 or 9%, maybe a different idea. But when rates are at 4, 4.5, 4 3/4,
and also let's face the fact that you may need a write-off.
And that's where I was headed with the other one. So when you're paying cash, one of the things that you lose is some of your tax write-off. You're not getting interest write-offs. The other big thing that a lot of people don't know about, and this is where the CPA world comes into place, is if I pay cash and then at some point in the future I go and take cash out of my mortgage because I need it for some reason, I can only now deduct up to $100,000, that the interest on that first $100,000, not if I pull $250,000 cash, I can't deduct anything on that $150,000 after the $100,000.
Well, you know what? I got to tell you, there was an article here in the what was this article in here? I forgot here now. KCM blog, Keeping Current Matters here, and they were actually quoting billionaire John Paulson, and John Paulson, they said. He's the guy in 2005 and 2006. He made a fortune betting that the subprime market mess would cause the real estate market to collapse here. But you know what his bottom line is and what he says today? He is actually telling you here today that the best thing to do today is to be a homeowner because there's the interest rates, as you said, Chris, are so low that you cannot buy cheaper money than what you can get today at all. And you'll get a bigger return on that kind of investment by buying a piece of property here today. Hey, you guys, if you are interested in getting a home buyer's guide or a seller's guide, go to denverrealty.com and just scroll down right below the panoramic image and you'll see it right there.